Hello and welcome everyone. We're going to be talking about contrarian investing today, trying to understand what it means and hopefully come away with some actionable things that we can do to take opportunity in the market and at this time. So, but first I'm going to get everyone to introduce themselves. Maybe Doug, James, and then Ryan. Do you want to take it? Do you want to go from the top?
Sure. Hi everyone. My name is Doug Ramshaw. I'm the president of Minera Alamos. Bit of a contrarian in that we like to build gold mines rather than try to find them for other people to build. We've got one mine operating in Mexico, two new development projects to sequentially build our production profile there in northern Mexico to come on stream over the coming years. And yeah, that's where we're at.
James?
Hi there everyone, James Withall, CEO of Rupert Resources. We are the exploration, explorer developer ultimately in Finland. Made the Equities discovery in 2020 and progressing that forward, plus continuing to demonstrate what the other exploration upside is there as well. So different stage to Doug, but earlier stage, but all part of the same sector.
And Ryan?
And I'm Ryan McIntyre, the president of Maverix Metals, which is a royalty and streaming company. We've got 148 royalties and streams today, 14 of those currently paying. This year we expect revenue north of $50 million at a 90% gross cash margin, and are dual listed on both the Toronto and New York Stock Exchanges under the symbol MMX.
Thanks very much, guys. I'm getting a bit of bookshelf envy. Doug, I'm going to start with you. You look like you're sitting Jerome Powell's chair at the Federal Reserve right now. So I'm looking forward to what you've got to say about the market. Let's try and describe, what is contrarian investing because it's a sort of trite phrase that's kind of pulled out when markets are good. But in moments like this, people kind of seem to forget the phrase. What do you think it is?
Yeah, I mean, there are lots of cliches for it. I mean, for me, it's funny when I think about what we do as a company. We're also investors, or at least I am, in this mining space, whether good or bad. A lot of what I think our shareholders are dealing with, or shareholders broadly across the sector, is I'm looking at that myself as an investor. So, contrarian investing, I mean, we've been in a 2-year downtrend after a 4-month gold bull. It was pretty much we had 4 good months post COVID, and the market topped 2 years ago. So it's not just that there's blood on the streets. It's been pretty bloody for 2 years straight now. It's just been kind of somewhat covert in this death by 1,000 cuts, as opposed to the brutality of, say, March 2020. So, but I think a lot of those experiences can inform us as investors as to what to look for and how to approach maybe committing capital to a sector that seems very beat up right now.
Right, and James, for you, I mean, how do you do? You were a finance guy before. You invest your own money, and you run your own company now. So you're wearing multiple hats. I guess you're sort of torn as to how do you play this market. But are you taking advantage of it in a contrarian style?
I think, I guess, yeah, a few different hats there ultimately, and I think a bit like Doug. Really, I guess I'm an investor at heart ultimately, and that's what I did before this. I was a geologist first, but an investor as well. And even as a young geologist, you get involved in investing tends to be if you're interested in that part of the sector. So I think, I don't know, the contrarian side of me, I guess we looked at that a lot, and it's a lot of cliche around it, but I always look at it slightly differently. These periods that we have, like we're having now, I guess they force you to really focus your mind on what you're investing in and the quality of what you're investing in, and reality, the longevity of that investment as well, because there's all these different aspects to it when you're looking at allocating the money, but ultimately this market's been quite interesting because you've seen some companies, probably rightly so, completely really driven down hard by the market. And I think the market is really differentiating between what's worthwhile investing in at this point in the sector, what's worthwhile holding on to. And it just, if you're the whole contrarian side, is you have to work a lot harder at this point in time in the market to spot the things that you liked them before and they're really good quality. So you should probably do some more work on it to make sure it's still okay. But ultimately the contrarian investor allocates capital at this point in time to those things that they still really, they've got a sense of trust and this is with the management and the quality of the business. So it's kind of a process you go through when you're thinking about this environment or the process we're in. Whether there's, it's quite hard to define it. Matthew is what it is.
Well, it is.
More of a process.
It's even harder because good companies and bad companies alike have been hit. They are. I want to use the phrase discounted. Well, the good ones are discounted, and the not so good ones have kind of perhaps come back to reality somewhat. And we'll come on to some of the points that you raised there in a second, but I want to get Ryan into the conversation before we kind of open this up and rather run it as a panel session, just have a conversation between some guys who've maybe been around the block a little bit. So Ryan, for you, are you the only guy in the room who doesn't really mind if there's a slight downturn in the equities market because you've got a long-term horizon?
Yeah, I think, at Maverix, we definitely have a long-term horizon, in the sense that we're purchasing royalties that will hopefully be generational and that will never sell. And so from that standpoint, more than happy to kind of fill the role of providing capital during downturns. In fact, it's probably one of the busiest times for us. Just the cyclicality of the space actually lends itself to our business model quite well in the sense of there tend to be a lot more things to buy on the royalty side in downturns, and conversely, fewer things to buy when times are really good. But we're also generating more cash flow that we build up during those times to basically buy things at times like today. So I think we're set up pretty well. And I guess just for my own personal sense, my whole psychology is probably in that contrarian or value mode, just generally speaking. And to me, that means doing things or looking at things on the investing side that other people aren't looking at. Because usually when you've got a big crowd following one thing, psychologically, it's easy to follow that. But financially, it usually doesn't end up as well as that. So it's usually the tough times that are the better financial times to invest.
Well, actually, so sticking with you, Ryan, isn't this time to make hay? Because there's a lot of companies that are cash constrained at the moment. The equities market isn't necessarily open for everyone. The cost of money is certainly something that they'll be looking at, and obviously dilution when their share prices are depressed like it is. Is it a better time for you guys? Is this where you do most of your business?
It's where we do a fair bit of it, I must say, and I think we do a lot more quantity and probably better pricing as well. So you get both usually at the same time in markets like this, which is great for us. And I think especially companies like James's and Doug's. It's time for them to make hay as well in the sense of setting themselves up and separating themselves from the lesser companies in this space. Because, as an investor, you can now look at a bunch of different companies that are really high quality, like James and Doug's, and you can actually say, wow, these are really good people. They have great projects or assets. Now's the time to do it because people are discounting that as much as something that is poor quality anyway. So it's the perfect time to go around shopping.
Well, it is, and I think that's where we want to get to in this conversation for investors. But the problem is this, and I said it with James, is like all companies have been, hurt. They had their cut off at the knees somewhat. Stocks are down, 25, 30, 40. We've seen 70% off the share price. So given that everyone's behaving the same way, what are the red flags that you would look to, Doug?
Well, as an investor, we're definitely, I think it's nice to look at the sector now and realize it's not a crowded trade. And that's a good thing. We saw it briefly in the summer of 2020 where money piled in and we had a rising tide lifts all boats. But leading into COVID, we actually had a tough market and most of the capital was going to 10, 15% of the companies, and it was a struggle for those others. In reality, when I'm looking at anything right now, I'm looking at, do they need to finance? Because what might seem like a great opportunity to buy in, the dilution impact of equity that's required to actually see their projects through over whatever the market's going to be like over the next couple of years is to me is a key consideration. And the great thing is nowadays, as opposed to 20 years ago, investors have the opportunity of really understanding the financial state of the company. I think back to that 1990 discovery cycle. We got our quotes looking at the paper the next day. We got our financial statements mailed to us. Now you can, with CDAR and CDI, the tools are all there for investors to really have a much better understanding of the financial health of a company. And that should be an absolute key consideration when looking at this kind of waste ground of companies where there's real value to surface, focusing on some of the better companies, because they have all got drawn down to various degrees, is understanding that what might seem like a good buy today, are you going to feel diluted 3 months, 6 months from now, because of the financial requirements of companies in this space. So I know every investment I'm making right now, I am looking, is the company financed? Because I don't want to be guessing where that funding is going to be, especially when we're about to go into or already in tax loss selling season, right? Which is just going to put further pressure as we all kind of clean up our portfolios to see what's left, what we want to continue to back moving forward. It's just going to add further pressure on these companies.
Okay, so that's timing of money and cost of money for you. You don't want to take that hit. And we'll come back to tax loss season as well, because I want to talk about where the bottom of this is. But James, if I look at your company and the way that you've gone about it, a systematic process, I think you've also got the benefit of having your kind of fund manager hat on. How does a company like yours need to play this? Because you've made a discovery. Do you get focused and just focus in on that because that's what where the success is, or can you go out and allocate your capital for new discoveries, new acquisitions, or however you intend to play it? Because you've got to send the right signal of that to market.
Yeah, no, it's the issue. I mean, reality is we started this company in a really bad market in 2016, 2017, and we raised money through that downturn. And really what that comes down to, people need to look has that company been able to raise money, and what's their shareholder register like, really in terms of the support that company has had through good times and bad, especially in our space where we are an explorer, so we're totally dependent on external funding right now still, and we're not producing cash flow. So you have to sort of look at the company's track record and the people involved in it, and have those, has there been a massive turnover in the shares? Because if those people supported that company previously, they're most likely to hopefully be able to support that company going forward if they have that ability. That's absolutely key. But in terms of what do we do now, I mean, we're in a fortunate position that we raised a significant amount of cash to make sure that we had a long runway, and that gives you flexibility and different options. We are continuing to explore, because obviously we still see that as one of the most important ways to generate value. And I think what frustrated me as a fund manager in some ways is the fact that you can't be an exploration company and sit around not spending money. That's like, don't bother investing. That's just total waste of time. Otherwise, if the day they stop exploring, or say they're hunkering down and not going to sell money, then there's no catalyst for them to generate any value, no way to be able to possibly get people to put money into the company, really, because there's nothing new. The value has been defined by what you've already discovered. So you have to be, it's as ever with all these things, you need to follow the companies. I think those were absolutely clear. You need to follow people's financials over a period of time. Don't just look at the last quarter. Look at them over the last couple of years and see what the trend is like, and have they been allocating capital well in that time? And exploration companies are just allocating capital. So have they been getting results from the allocation of their capital, or has something, has there been some, volatility in that, and big change in the people, those kind of things. We have the flexibility right now probably to tone down the exploration if the market gets really tough, to extend the runway of the funds. We're in that fortunate position, but also we've already made the discovery. We've got 4 million ounces under a belt. It's not as though we're, that has a specific value. We're about to put the PEA out, and that will put a value on it and a potential on it. And so that puts us in a very different position to some of our peers, where it gives us options to be able to raise money. And you just, you're not going to just go out and raise just because you thought, oh, next year I had a planned budget of X for the year. You're not just, if the share price has changed significantly in that period, you don't just carry on with that plan. You've got to change your plan and adapt it. You might raise a smaller amount of money now. You might go and have a chat to people like Ryan on the royalty side and see what options there are there. And just about managing it. It's all about managing the risk.
That's a great point actually you raised, because obviously, Ryan, you offer non-dilutive capital for companies to do what they want to do. Are you seeing pressure from other kind of cash sources that companies are looking to? Because in desperate times, desperate people do desperate things. They'll look at all sorts of death spiral type structures. But where do you see the competition coming from for you?
Yeah, so I think the competition today is certainly less from equity. So usually that tends to crowd us out during, I would say, good times in the space. So it's definitely stuff that's, I would say, off market in a way, sort of, these debt structures that are sort of covenant-like type things, but are high cost. I would say those types of things are kind of coming in to fill some of the roles of maybe previous capital providers. But I would say royalties are certainly playing a bigger role now than they were a year ago, certainly in conversations. And just going on to James's point, I think it is very important to focus really on the people and the plan, right? And I think it's completely obvious that sometimes it'll be good, better than you expect. Sometimes it'll be worse than you expect, for no fault of anybody per se. But to me, it's management's ability to adapt to that and to carry on a good plan in both good times and in bad times that really makes the huge difference. Because I could see some people starting out with a bad business, but if they take the capital from that bad business, put it into a good business, that is huge value add. And to me, it's things like that it's all about the people in that stage. And so I think, people managing budgets now and basically, allocating their resources in a more systematic, targeted fashion that's going to basically get the most value for the buck today is critical. And, I think to James's point, it's not such a great idea to hunker down. If you have to, I guess you sort of have to if there isn't capital. But, to me, this is a time where you can actually target and differentiate yourself a little bit from others if you are moving things forward, even if it's in a slower way. In a more targeted and slower way is better than not moving at all, I would say.
Right. Okay. And I just want to say to you guys, feel free to ask each other questions or build on each other's comments, because the people here to listen to you, definitely not here to listen to me. But before we do, Doug, and obviously contrarian investing requires a bit of patience. If we look at the last chart for the last 2 years for most gold and precious metal companies, it's a ski run downhill, it seems. So what's been happening? What's going to give soon? Because gold bears are blaming everything and anything. It's the Fed, it's the interest rates, it's the dollars, it's shorters, it's inflation. It's no one quite has an answer. Do you?
Well, I'm certainly not going to use those answers. I think it's interesting you mentioned patience, because I think one of the hardest assets for companies to come by, and it takes a lot of work, and it takes a lot of execution and doing things, like James said, is if you're going to raise money, use it to build value and build that track record. Well, it's really tough to find the very patience that is required, whether it's drilling out a huge deposit like Rupert's had, or building out a sequence of mines like Minera has. There's always going to be turnover. But I think, fortunately, if you can set yourself apart from the large swath of companies, and we have way too many in this sector, and I've said that before, and I'm not going to repeat myself, but I can see why in the junior expiration end, when everyone is trying to get that next marginal buyer in the stock, the impatience there amongst shareholders is tough. But in terms of this, in this sector, there are a lot of, we actually saw incredible discipline in coming out of the last gold bear market, where companies were forced to rationalize operations, rationalize costs, and they bolstered their balance sheets. And we had a heck of a market in 2019-20 as gold, tailwinds were there for gold even before COVID. And we saw GDX and GDXJ, up there in September 2020 as margins absolutely expanded amongst the producers. And the biggest problem I think facing the sector right now is at the high end, and let's face it, contrarian investors or generalists looking at this space, they're going to look at the performance of the GDX or GDXJ. I don't like those ETFs, but I mean, they're bellwethers of sector health. And we've seen, we've seen those suffer a death by 1,000 cuts for 2 years straight now as margins have contracted consistently. And now we're seeing inflationary pressures both on CapEx, which is impacting a lot of developers, and op costs. When you're looking at Newmont year on year was a 16% increase in ASIC. It's all that's doing is limiting their financial performance. And I think from a contrarian investor perspective, one has to look. My habit as an investor is I'm not trying to catch a bottom. I'm not trying to catch a top. I've done very, very well playing the 60% between. So I guess if we look at what the last 2 years has done, has it got us into that territory? We're in the bottom edging into that 20% bottom of the market, where there's an opportunity, whether you tranche in all in one go or just tranche in, which I think would be a more appropriate way of doing it, and play the 60% rebound. At some point, it's going to probably come in the better names for sure. But until the US dollar, which if you'd ask me, coming out of COVID with the huge debt burden in the States, like so many other countries, the strength of the US dollar is absolutely inhibiting gold's progress. But are we close to a top in that? So again, can you align? Are we close to getting into that lower 20% of equity value? And are we in the next 6-7 months? Are we close to a topping out of the US dollar? And certainly there are forecasts that would suggest that. Then maybe there's a perfect storm, and maybe this is the time. Whereas contrarians, which I think if you're looking at the gold space, you have to consider yourself a contrarian right now. Is this a window where you're not looking for an immediate bounce, but you're trying to play something that should bounce over the next 12 months if these things coalesce to create a bit of a perfect storm that can drive equity values upwards after 2 years of downturn?
Well, James, can you put your fund manager?
Yeah, look, I think it's I think the position where we're at. I mean, I'm sure there's plenty of people on this chat that have been looking at the gold price for tens and tens of years. But when you look at the previous gold rallies, if you're in the UK right now, or even in Europe and Finland, we're pretty happy with the gold price in our local currency. And if you look at previous bull markets and the US dollar price for gold, it tends to rally first in other currencies, simply because you have the strong US dollar ultimately, if you see what I mean. But I'd say in the UK, we're still in a bull market for gold right now, because ultimately it's a currency. So I mean, you'd be very happy if you're a UK fund manager that allocated sterling to gold, sterling assets into gold throughout this last few years, even though you're suffering a bear. We talk about the gold price being down in US dollars, but you got to look at the perspective of it. So I think, and if you go back to the great, so 2002, 2003, before the gold price really rallied, then you had quite a strong rally in non-US dollar in the gold price, quite a long way before it really picked up in US dollars at that point in time. So I think you have to be careful on the perspective of what you're looking at the Aussie dollar gold price obviously been very strong for quite some time now. It's a little bit weaker, but I think again, we do tend to get very caught up with the US dollar gold price ultimately in the sector.
Too much so, I would agree. But it is a bellwether, right, James? Just like,
absolutely,
I guess the point I was trying to make, that I think from a sentiment perspective, a sentiment shift, just like the GDX or the GDXJ kind of are these, for generalist investors, they're going to look at the health of those markets. For the same reason, I think people look from a sentimental perspective at US dollar gold. But you're absolutely right. I mean, look. Yeah.
It's going to be interesting. I think it's, and I think your point, the other point you made is the fact that the space is so under-owned. It's these days, and people, even you would say that there's been a sellout for gold to some extent. ETF volumes have come down quite significantly. So, we know that it doesn't take a lot of money. Think of and the thing that's changed in the last 20 years is how much money there is around looking for a space to invest in. I mean, it's a whole quantum change in the last 20 years. So, if only a small part of those assets start looking to invest in the gold sector, be it in physical and the equities, I mean, the chances of a step change in the performance of the equities is you might, unfortunately, you might not get much selectivity in that. Obviously, they'll pile into the GDX, GDXJ for a start, so it's handy if you're in that as a company for sure. But I think they'll also look for other quality investments to go into.
Mm-hmm. Ryan, have you got a thought on that?
Yeah. I was going to say, I think patience is critical. I think Doug mentioned that at the beginning. And, to me, when I look at, the space of where gold is now, I look at one big thematic in the world that I would say has captured a bit of the crypto attention is more that disconnection from governments, right? I think people actually do want to be a little more disconnected because, frankly, I think people have a little more distrust for them now than they did 10 years ago or 20 years ago.
3 years ago.
Right? Exactly, right? I mean, look what happened to, the Prime Minister of the United Kingdom, right? I mean, the trust factor is very low. And to me, I think gold is the ultimate investment if you don't have any trust in your governments. And I think a lot of people would say they don't. And then, frankly, there's probably good reason for them not to, just given, frankly, there's been a ton of debt issued over the past decade. And, when you look at the past kind of crises, it's always been managed by the government by basically giving out money, right? They're printing money to kind of cover up some of the issues. So pretty easy to bail out corporates if you're the government. The one thing that I do fear that I think could become a thematic, which I think the UK became sort of a test case for, a very small extent, is the idea that sovereigns might become more unstable in the markets, right? So they're walking this fine line now, having a lot of debt with interest rates going up. And the idea of papering over the problem, I think, is going to be much more difficult to the extent that we have a bigger problem. And so to me, I guess when I look at gold, I think of it in two ways. It's a proactive investment in a sense, because I think people want to gravitate a little bit more towards things that are independent of the government. But I also think it's a defensive position as well, just to the extent that, I think it's always been a very good insurance policy against, negative events. So it kind of acts in two different ways in today's scenario, which is perfect.
Someone put this to me the other day, which was about the sort of, now how to sound like an old man, the younger generation don't have the history with gold. They don't have the same love for gold because they're distracted with technology and crypto and lots of other things which are based on the reality of their everyday rather than a protection for what may come in the future in terms of investing or otherwise, with all this conversation around fit. So do you think that disconnect with the next generations is going to cause gold a problem, or is gold just bigger than that and it will smash its way through any of those roadblocks?
To me, it's an untapped market, right? Because I think you're absolutely right. I mean, I think the format that people have previously viewed gold in, it's either sort of on a physical basis or maybe they're dabbling in the equities. But to me, if you can get some sort of blend of electronic gold in some fashion or form, which is pretty straightforward now. But to me, one of the early signs that we've seen is we've actually had a few crypto investors actually gravitating towards gold. So we've seen it actually in some of our interactions, either by email or some actual meetings, where you actually are getting a bit of the younger generation taking a look at gold after transitioning out of crypto. I think it's very rare still, but I think some of them are starting to make that connection.
So they understand the concept of gold, or you think there's more work to be done there?
I think there's a lot more work to be done there. Yeah.
Okay.
Yeah.
Without a doubt.
There was quite a lot of progress on that. Oh gosh, 7 or 8 years ago, and and now you can buy digital. There's a digital way of buying gold or owning gold in in process with some of the mints around the place. So there's a lot more. I think the gold money vehicle that was brought in that looked at monetizing that, and you can actually have a debit card that you'd effectively use against your gold account with them. So there are definitely ways to it. It just hasn't evolved. Obviously, with the arrival of crypto, that surpassed it all anyway. So, but it could well be developed, and it could well become more popular as the physical asset I'm talking about in terms of the gold that's already above the ground.
Do you think gold? It's like the battery metals. People understand the need. People are very excited about the EV revolution, and they're excited about infrastructure builds across the world. Benefiting a broad suite of battery metals as they're labelled. Gold doesn't have that utility. It relies on a different set of narratives and messaging. I know there's some in electronics, but not major, right? So, do you think gold is sort of taking the back seat, and that the battery metals are maybe taking some cash away from investments like yours? I mean, Doug, what do you think?
Well, I was reading something a couple of weeks ago that there was going to be more of an ESG pushback against gold, exactly because of that. Like there's damage to the environment in terms of holes in the ground and everything. For what purpose? At least with copper, you could say, well, it's going to drive the EV revolution. It's going to help societal, technological, and likely climate change as a result of that. So those holes maybe are a little bit more justified. So you can, it was interesting reading that article a couple of weeks ago in that regard. I think honestly the greatest form of flattery gold has had in recent years was when early Bitcoin adopters approached gold with, this whole drop gold campaign. Their attack on fiat, was vulnerable to the fact that, but hang on, gold's always been there. And I think it was flattering in many ways that they viewed gold as something that almost needed to be slain first before they approached fiat at large. So, I mean, the reality is gold has history, remarkable history, and you see that very history as part of cultures still to this day that make it a huge part of their lives in investing and buying in gold. India, obviously, a classic example. So the problem for our gold sector is, I think a lot of investors in it reflect gold's antiqueness in that you go to typical conferences and there's a lot of old guys watching this stuff, and I think it is a problem with this space. I actually hope that battery metals, copper, we saw it with lithium, 5-6 years ago. The early lithium companies, I thought they were run by young people, dynamic, that understood these new markets. Old 60, 70-year-old geos would go, lithium, it's everywhere. They saw an opportunity, they created value, and I thought it was fantastic because you saw younger investors that more reflected those younger CEOs coming into the space, making money in early lithium and thinking, hopefully looking, going, what else is there in mining that we can make money on? So I think battery metals and copper at large, hopefully are the very conduit for bringing a younger demographic of investor into the commodity space. And hopefully from that, some of them actually do understand gold's history. And whilst it might not have the utility, there's great value. I mean, up until 3 or 4 months ago, you'd argue that gold was doing precisely what it needed to do this year. As Ukraine happened, the bond market collapsed, as all manner of crypto collapsed, gold actually was holding its own. It was doing precisely why you have some exposure to it. You shouldn't be like me and have way too much exposure to it, but there's a place for some modest exposure to gold in everyone's portfolio.
Right, and I think I think there's a few questions have been sent in, which I want to tip my hat to. And then James, you've referenced 2002, 2003. Are there any other kind of moments? I think James in the question section is talking about 2008, where we experienced a similar feel to what we're going through at the moment. I mean, do you agree with that, first of all, James?
I don't think it feels like 2008, really. I think there's quite a lot of different dynamics going on now. I mean, certainly in the rates environment, I think I guess I guess what it probably maybe just that, but what are the potential headwinds for it as a commodity? I guess you've got a situation where, if inflation does come back, if they do get it under control and rates stay high, we're definitely not a positive real rate scenario now with the way inflation's running. But I guess there is that fear that you could be in a positive real rates environment, and that would be quite a turn off to gold for sure. And I think that would be as an asset allocation decision, that would make it quite hard for people to allocate to gold right now, or allocate more to gold effectively, or keep it in the portfolio. There'd be other things in it. But then if you step back, the chance of that happening in the short term aren't particularly high. I don't think. It's quite hard to see that environment, especially as Ryan pointed out, just with the huge amounts of debt that are out there these days. I think so. There's been a seismic shift in government debt, hasn't there, since 2008. That's why I don't think you can compare the two environments. 2008 was the catalyst for a lot of this money printing.
Right.
Now we're in an environment where it has been printed, it exists, all that QE was done. Inflation ultimately is, if you're a government, you kind of want to do some inflation to kind of inflate away some of that debt anyway. I mean, there are positives to this, that high inflation environment. Unfortunately, it's pushing interest rates up, which is putting the cost of it up. But, so sorry, drifting off tack probably a bit, but I think it's quite hard to compare the two right now.
Right.
The circumstances are very different. But I just like in 2008, having an allocation to gold and sticking through the crisis with that allocation to gold, and even being prepared to put your toe in the water and add a bit more to your allocation with the really stressed time, really paid off in 2009 and 2010. I mean, it's just transformational. It's a small sector, but it really outperformed. So I guess if there's an opportunity maybe.
I've got a chart here from JP Morgan which talks about it's a 20-year annualized returns by asset class, right? And it's from 98 through to 2008, so it not quite up to date, but you kind of get the gist in terms of this contrarian conversation, right? Where it puts obviously inflation over that period 2.2%, average investor return 1.9, okay, gold 7.7%, right? So, and there's lots of other asset classes in there. I think REITs seem to do exceptionally well, nearly 10%. But it puts that down to people flipping and flopping, like, diving out of investment classes when the markets are bad and putting them into other markets where things are doing slightly better, like tech. Oh, tech's doing well, I'm going to go in there. I'm going to dump my mining stock, I'm going to dump my whatever stock. And that kind of flipping and flopping from one thing to the next has meant that they've underperformed, according to JP Morgan. And they talk about fund managers as well as regular investors making the same mistakes. So if some sort of an advocacy for contrarian investing that may help people somewhat. What do you think, Ryan? Does that surprise you? Any of those numbers?
No, not at all, actually. I think we talked about, I think the key is sometimes just sitting there and not doing anything, right? So if you're an owner, something that is done very poorly, the key is to stick around as long as you believe it. I mean, if something has changed, then maybe it should change out. But I think fundamentally, people try to be overactive, generally speaking, and they reach for things at times when are good, they probably shouldn't, and vice versa, they probably don't. They might sell out just to avoid the psychological pain of holding something that's gone down. But again, to me, what separates the great investors is sort of having your conviction, whether it's with the people or the project in our space, or just the commodity itself of gold. To me, the key is just sitting there and just maybe adding more at times are low, and maybe trim off a little bit when times are really good if you need the money or what have you. But I think just going back to, I guess, the previous question about timing and what does this feel like, you've seen a couple of interesting things in this space, and that you've actually seen a few bankruptcies. Some of them were self-inflicted, but I would say. But the one interesting thing is you're not seeing any capital come in to rescue them before, whereas it would have said in more normal times, there would have been some level of capital to come in and, maybe take them out at a horrible price, nonetheless not force them into bankruptcy, which is what you're starting to see now. So I think, to me, as a contrarian person in general, I think that's a great thing to first first line of thing to see. I mean, when you don't see that come in, probably a good time to start taking a look at the space.
It's interesting. That's a great point, actually, Ryan, you make. Doug, should we talk about bottoms? How you spot bottoms, how you trim, how you average down, how you average up. As a contrarian, you said at the outset, in a meaningful way, you want to kind of play in that 60% zone and not worry about trying to predict when the market has bottomed. We've got tax loss season coming out, so I've seen in Canada, so I suspect there's a little bit more pain to be had. So for people sitting in the sidelines, how do you suggest they play this?
Definitely tranche in. Absolutely. This is not the time to just go in on a particular name. Don't spread your capital too thinly around. I think there's enough of a runway ahead of us in terms of this bottoming phase where one shouldn't be rushed. One should start looking at the history of the company, as James said, whether it's how they've executed, how they've spent their money. Does the business plan make sense now, like it did a couple of years ago? And then think about the companies, the ones that are going to bounce first and actually be conviction bounces. It's the same types of companies that were actually performing well before gold ran. Those are the ones that I think you want to be buying stuff where you don't have to check the stock price every given day, every given week, every given month. Honestly, I've tried to create a culture amongst our shareholder base of just set it and forget it. Believe in the business plan, believe in the team's ability to execute on that business plan. If you want exploration, that's the kind of stuff where bad drill holes can come up on early stage, which can offer unbelievable returns when they work. Rupert's a great example. Great Bear I was involved with was a great example, but there are so many that don't. And then you have to constantly be worried about waking up to a 50-60% decline on a bad drill hole. So think about companies where you can kind of set it, forget it. Think about this as a bottoming phase in the sector. If you're starting the process of investing in one of those companies, tranche in. A good example yesterday on something completely unrelated to their operations, a company like Calibre that just had 2 brutal days off the back of U.S. sanctions against Nicaragua. It had a close to 50% haircut in a matter of a couple of days. There was so much uncertainty out there. Probably I said to a friend of mine, it's like, it's probably a good buy, but tranche in because it could get worse before it gets better again. Tranching is really important. Taking advantage of a tax loss selling season, which is, it's easy to look at a company and go, well, I'm not going to be a victim of a tax loss sell because I'm only off 15% this year. There are companies off 70% this year. Tax loss is a tax loss. I know that from my perspective, I'm going to be, further ordering my portfolio this year. And I don't really care if it's just a modest tax. I'm not trying to just create the worst tax losses. And I'm not looking to create a tax loss to buy back into a company 30 days later either. Typically when I sell, it's because it's like that one has not worked out for me. And I'm going to be looking and thinking, where do I want to concentrate my investments to take advantage of whatever might be coming in terms of a bounce. So, I think tax loss selling season is probably every year. It's like Christmas decorations in Costco. They're every month. It's every year. They seem to be out there a month earlier. Now and I think tax loss selling season is exactly the same. It's just become an earlier process. So that creates opportunities as well. So long as you have that long-term patient thesis with your stock selection.
Right, and James, I want to talk about because you've been quite good at kind of giving us moments in time that we could look to and maybe learn from. But for people who are perhaps not brave enough to be contrarian in their investing, perhaps they want to, well, maybe late stage contrarian, we'll call it. What are the kind of breakout signs that they could look to? And that's actually a question from Douglas in the chat room. So good question.
Yeah. Okay. No, it's a good question. The breakout signs. Yeah. I guess if we look, I think that right now there's everyone, you're going into the quarterly reporting season. I think everyone's going to be worrying about people's cost profiles and what's the inflation been in the last quarter. I guess I think if we start to see a tempering in that inflation, I think, and the costs, and people think actually the gold price at 1650 is pretty good, and these guys are making decent amounts of money. That could be, goes back to this point of looking at the balance sheets and looking at the accounts. Actually think, well, actually these guys, now they're trading fundamentally cheap, as in just on a cash flow basis or price earnings basis. You think actually, okay, I can get comfortable with that. But if you start to see, and then if those numbers look a bit crazily low compared to other parts of the sector, that for me is always like an indicator that you should probably start thinking. I mean, be careful that you're not buying something that's crazy low for a reason. But ultimately, if it's been a good business, and then it's like, it's very mispriced compared to where it's been before. It's either implying, obviously, the gold price is going to fall a lot further, but at the same time, I think, you have to get, if you're comfortable, if you can get comfortable with the gold price, just keep an eye on those and see whether on the back of some of these results, after you look at the pattern of the results, it starts to level out a bit. I don't know, other catalysts, I guess. Put me on the spot there a bit, Matthew.
Well, okay, maybe Ryan can help you out. He's a good macro analyst.
Well, I think there's a macro perspective. I think you have to figure that we're pretty near the most pessimism we can have on inflation, I would suggest, right? Yeah. So the idea that central bankers probably are going to go, they're either going to keep it at the high interest rate, increase is pretty high, or they're going to start tailing the back. That's my feel is the baseline is already at the high level. So my feel is that it's probably going to be upside to the extent that they become a little bit more moderated, which would help the gold price and therefore would help the equities a lot. Mm-hmm. And the one thing I've been looking at recently was just based in the United States, but looking at the U.S. money supply. Because typically as a central banker, it's one of the key things they should be watching, because one of the things you do not want as a central banker is a shrinking money supply, right? Because then it has negative reverberations and effects in other things, the lending the most particular, and then basically just would lead to a huge slowdown in business. So you've rarely had times that it's gone negative in terms of growth. And it's actually recently that it's really started to flatline or go a little negative, which is pretty rare actually, depending on which metric of money supply you use. And to me, that's a bit of an interesting point, because I'm sure that has not gone unnoticed from the central bank level. And it would be shocking if they kept on accelerating. I would say that would lead to huge pain for the economy, which would lead you to want to probably own gold. And then conversely, if they go the other way, the same situation, they decelerate a little bit, it would probably make you want to own gold even more. So the first one would be for protection, and the second one would be for more of a proactive approach to how the central banks are going to go. But I guess that's sort of the leading thing I'm looking at is where's the money supply and where's that going?
Right. It's interesting. Guys, I'm just kind of conscious of the time here, and I just want to say this. 2020 was the birth of multiple geniuses. Investing geniuses were born in 2020. Today, not so much. I think that people have realized that perhaps it wasn't their genius, it was good timing. Lots of people in that camp. And I think what investors are looking to words of comfort, from experienced people like yourselves. I think today's conversation has been brilliant in terms of referencing what's gone on in the past, maybe some lessons, maybe about what we can learn from the past, and maybe the ways that we can approach our investing today. Contrarian investing is not for everyone. You can make a ton of money if you do your homework and pick the right horse. So I appreciate your time sharing your thoughts, views, experiences today. And I'm going to let you all go out. This is the quid pro quo for me, which is for sharing your time with us, is maybe you can spend a couple of minutes on why people should be perhaps considering your company as one of those contrarian bets. Doug, do you want to take it?
Sure. And thanks, Matt and James and Ryan. It's been a pleasure this morning, and hopefully informative for the audience. I think it's funny. I've been giving a presentation on Minera called Building Low CapEx Mines in an Inflationary Environment, since inflation was transitory. It was always a smart business model, building mines cheaply, getting them up and running, and then funding the exploration, funding the growth out of cash flow, rather than that hamster wheel of constant trips to the equity market. As a result, we've barely gone to the equity market in the last couple of years. And really, with this inflationary environment now, it's really emphasizing our business model. It's not just smart back in 2019. It just seems perfectly fitting for this sector. We build mines for sub $30 million, which means if we do experience a 25% capex overrun, it's $7 million. It's not going to see us go to the market and have to do some big cost overrun equity raise. And as big shareholders ourselves, we're really cognizant about dilution for all shareholders, not just ourselves. So our business model, building out a production profile, of 150, 200,000 ounces a year from a number of these low capex builds, I think insulates us from that very risk that we've seen with a lot of single asset developers that sometimes through no fault of their own have just started a process that can take many years. You enter an economic environment like the one we are now, and it creates problems and funding shortfalls and the like. And unfortunately, those funding shortfalls are always impact you, the shareholder. I think the biggest aspect of Minera being a contrarian is we're one of the few companies that actually wants to get to the far end of the Lassonde curve and actually build long-term value. That immediately sets us apart. I think within that group of companies, we further set ourselves apart from this very low capital intensity mine building strategy we have, and looking forward to delivering on mines 2 and 3.
Good man. James, what about you?
Look, I think, I've been on a lot of your presentations about, or you spent a lot of time chatting together. And I think, look, the advice I have to the investors is really just focus on quality. I mean, the reality is there's a lot of product in this market. There's a lot of companies still listed. I think there's quite a few things in the chat. Why isn't there any M&A going on? People are frustrated that you've got all these companies in this sector. It's really, people. It would be a lot better if there was less. But I guess all you can really focus on is just the quality. You've got to look for those projects, that aren't, the differential between the a classic one, the differential between the NPV of the project and the capex. If it's 1-to-1, get very frightened ultimately if the NPV is only the same as the capex. It's little things like this, there's a bunch of metrics that you just think about when you're evaluating developers. Is the grade just the same as everything else in the industry? Is it like a gram, or is it a low grade thing? I mean, because then you can immediately, if it is low grade, the margin is going to be low. I guess you've got the exceptions where you have to look at the process. If it's a nice heap leach and it's a high grade heap leach operation, then it'll have a nice big margin on it. That's fine. But it's just refocusing and just calibrating. There's a lot of information in the industry. The industry pushes out a huge amount of information. Look at the really high performing mines inside some of the big companies, perhaps. Just deep dive into a couple of those and see things that really make money. And just have a sense of that, because whilst it's a broad industry, if you look at it, there's not that many companies that really generate exceptional returns or generate, really exciting returns to invest in. So as I've always said to people, that the average gold mine has a 10% margin after profit. That's not that exciting, is it? It's quite a risky sector to be in for a 10% margin. Try and find the ones that you think are going to have a 25% margin in the bad times. That are still going to. And when they're in the good times, those guys, they'll have like a 30 or 40% margin, and you'll really reap the rewards, and the market will reward that company. And it won't just attract a gold investor. It'll attract just investors that see a great opportunity to buy a good business. I think, we can get too sucked into just the gold type. You just focus on whether hopefully you invest in other sectors and just compare it to other sectors. Is it a good business or not? And I guess, what do we focus on Rupert is trying to define a really good business opportunity and develop a really good business. That's what it's about.
Brilliant. And thanks for that. Some actually quite good points in there. Brian, I'll let you finish off.
I guess just from a Mavericks perspective, I think we're really well positioned for any environment. And I think that's really critical, in the sense of we have a great balance sheet. We've got great cash flow coming in. Obviously, we're not directly impacted by inflation just because we take a percentage of the revenue. So I think that's very good. And I think also, from our standpoint, I guess what I would say to investors is let us do the work and put in your investment dollars to work in things that we think is good, that we evaluate with our technical team. So I guess with us, you pick us for being well diversified, cash flow generating. We pay a dividend. We've already got organic growth, and we're looking to deploy more money in these times that I think will generate a good return over the long term. So we think now is a great time.
Well, look, and gentlemen, I better wrap it up there. I know you've got places to be. The people listening in have got places to be. And by the way, for anyone who sent in questions, I apologize if I didn't get round to those. We'll forward those to the guys. They'll respond, and we'll get those messages and answers back to you. So really appreciate everyone who listened in. Great session, guys. I learned a lot, and I hope everyone else did too.
Thanks, Matt. Thanks, Ron. Appreciate it.
Okay, thanks again.